Greetings, this is Manu Walia from Continuum Global Asset Management on October 29th, coming live from the NASDAQ Stock Exchange. Actually, I'm just kidding. I'm sitting in the comfort of my home, but I found this beautiful background, so couldn't resist. But without boring you any further, I want to talk about the quantitative easing that we are so anticipating at this point in time, which the federal government in the United States is going to be announcing, hopefully, over the next few days, early November. Now, quantitative easing is primarily just funneling money into the system so there is liquidity for the economy to keep growing, so people have money to spend, and manufacturers keep producing products, and then we have services that we start buying more and more. Consumers spend more and pump money in the economy to move it forward. I believe that there is some pertinence to it, but quickly, let me give you a background of what this is about in my mind. To put it in perspective, I think that the quantitative easing or the federal government is acting as no different than a venture capital company that comes into a company that is not doing so well and is cash strapped. And they come in and they say, hey, listen, we'll give you X amount of dollars. You take those dollars and you start doing whatever you need to for your working capital, for new equipment, to hire people, and so on and so forth. But the truth of the matter is, a venture capitalist is looking for a return, and the return could come in terms of getting dividends paid at a certain point in time, or that company, if it is private, going public and giving the venture capitalist an exit route. In other words, they are using the capital to help grow the business. Now, if the United States federal government comes in and puts in 500 billion or $1 trillion in the market, what are they expecting to do? Well, hopefully what they're expecting is that the money goes into the right areas, that it goes back into investments and it goes into production or value addition to raw materials, so that there is more hiring and the cycle moves in the right direction. Not that people just get that money and somehow spend it and, leverage themselves more, which really can't happen. And we can't get into the details of the way the money flows through the system, but the most important thing I wanted to talk about is what's going to happen and how this QE2 may work. Well, when the federal government goes out and says, well, we're going to buy 10-year bonds or 30-year bonds in the open market, they might come out and start buying these things over the next few months. Now, who are the people who already own these bonds? Either they're institutions or regular investors like you and I. Now, over the last year or so, bonds in all shapes and sizes have done very, very well because rates have been going down, and the quantitative easing or the liquidity that the federal government has put in the market has really boosted the prices of these bonds, hence reducing the yields to right now about 2.6 on the 10-year treasury. Now, what happens when there's $500 billion in the hands of investors who have now given the paper known as the Treasury back to the government, and they've got money known as the US dollars? Well, they have an option. They can either go out and start buying more treasuries, which are paying nothing, almost 2.6% on a 10-year basis, which I don't believe is a great return, close to inflation or a little bit more than that. Or they can divert that money into other investments. Now, if you think about investments, what are the other choices that people have? Well, you've got stocks, you've got debt in shapes of bonds, which could be domestic bonds or international bonds. You could have commodities, excuse me, which includes gold and silver, or you can have real estate, and then lastly, alternative assets like arts and coins and so on and so forth. So for the majority of us who really don't know about arts and really invest in gold and silver and so on and so forth, what are we going to do? I don't think that I can just go out and say, hey, we're going to just start moving money into stocks. There is a rhyme or reason to move money from, let's say, one asset class into another. Now, I just said that if you've held on to treasuries for about a year or so, you've got a 10, 12, 15% gain. So you're very happy to take your gain. You're not going to go back and reinvest it into a 2.6 or 2.5% bond for 10 years, which is a pittance. So you go out and you look at stocks and you say, oh, there's quite a bit of companies, domestic and international, which are paying in excess of 4.5% in dividends. But then there's always risk with stocks. Now let's do an apples to apples comparison between stocks and bonds. If you look at the 2.6% return on a 10-year bond, that translates to $26 and about 12 or 13 cents as of today per $1,000 of investment in the US Treasury. Now, you know it's the safest investment in the world. Again, that could be questionable, but let's say it's the safest investment, AAA rated bond, US Treasury, paying you $26 a year. You divide the price by earnings, or 1,000 divided by 26, you get something like a 38 price to earnings. Right? So you're comparing a price to earnings on a US Treasury bond of 38 to right now, a lot of dividend paying stocks are trading below 20. Some are trading at 16, 15, but the range is between 15 and 20. From a historical perspective, the S&P 500 has traded at a 16, 17 price to earnings ratio over the last 50 to 85 years. So the comparison I'm making, apples to apples, you go out and buy a safe bond, but the price earnings multiple is a 38, which is very high in my mind, relative to an average of 17 or 18 for a dividend paying stock, which is paying you 4.5%. So in my mind, if you're a sane investor, if you believe that the US economy is now out of the slump, interest rates are low, inflation is low, we have a global economy that's going to put pressure on wages, so inflation's not going to show its ugly head real soon. This is an environment for growth. On top of that, you've got global growth. China, India, Latin America, Russia, they all want to trade with the United States. I think we're too myopic in thinking that all we do is import products. Sooner rather than later, we'll be sending a lot of products and services to these countries that have a lot of cash in their reserves. So all in all, if we make a comparison, we can make a very compelling case that stocks are going to do well going forward in comparison to domestic and international debt. Having said that, one has to be very careful about short-term and long-term fluctuations that can easily happen. For instance, right now, the Brazilian markets are trading, I believe in about 16, 17, 18 price earnings range, compared to India, which has really moved up a lot and is trading at about an average of 26 PE. So we all have to be very careful about our time horizons, our risk expectations and tolerance, and then start to gravitate towards an asset class. Having said that, we'll be more than happy to discuss this in detail on an individual basis if you contact us. Again, you can reach us at Continuum Global through our website, which is www.cgamadvisor.com. Once again, thanks for listening and happy trading.